It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group.
Hey, thank you. And welcome back. Another edition, another episode. We stopped doing seasons, so I don't even know what season this is. We're not really making seasons of this podcast anymore, but this is episode number 90-something. I think we're getting close to 100 episodes, Professor Plum.
Wow, that's a pretty good milestone.
It's not bad. It's not bad at all. Who would have thought that? We've been doing this a long time, and we're back for more. I'm Johnny Dean. I'm your podcast host, not an advisor, but I'm here with Professor Rick Plum, not a real professor.
No.
I'm a real podcast host. You're not a real professor, but you are a real advisor.
Yes, I am.
We were
certified, in fact.
Yes. Yeah, you are certifiable.
That's been said.
And certified. Certified financial planner professional. And we're here talking about, here's something that we haven't done this. I've been giving out our email address and talking about our website at the end of every podcast. And if you want to join us and ask questions, do so. But it's been at least 3 or 4 months since we've actually tackled some listener questions.
Okay.
People who have written in, and I know this is what triggered this because I believe you talked to this person yesterday or today, and I wanted to get this question in. So there are a couple of questions we have on RMDs. We've got a question about contributions to an IRA after retirement, and then tax losses, if you want to harvest tax losses. So these are the 3 topics that are going to come up on this program today. I'm going to tackle each one individually because these are important things. We don't talk about things that are unimportant. So can we just jump right into this thing?
Might as well.
Let's do it. This is from, I can use her name? No?
We don't have her permission necessarily.
All right,
so
then I won't
not
do that. Okay. Well, this is from an emailer somewhere in the United States. We'll say that. She had a question here, and this is a very interesting situation. She says, I forgot to, she says, reinitiate my required minimum distribution for 2021. In other words, I guess she means...
Well, in talking with her first required minimum distribution was in 2019. And then in 2020, they waived the required minimum distributions. Right. Okay. So most likely she told her IRA custodian,
don't take one.
Take me off the automatic. Don't send me anything.
Got it. Okay.
And then she forgot to re-up the required minimum distributions in 2021.
So I forgot to reinitiate my RMD for 2021, only realized it in January of this year.
Well, that happens, unfortunately, more than you would think.
It does. I rushed to the bank. I took the distribution and paid the taxes, so I guess...
She did withholding.
But they insisted they could not apply it to my required minimum distribution for 2021. So in other words, she missed it, but they couldn't
well, the bank is saying, this is a January 2022. We are going to code this as a 2022 distribution.
Well, she says, I sent a letter to the IRS and my tax preparer filled out the form to go with it. Now my bank is telling me they cannot do an RMD for 2022 because obviously they already did it in January of this year. She says, how am I going to take my RMD for this year? I have to find a way because the bank is not going to do it. Thank you for any information you can give me. This is a nightmare. So
well, the problem is we're dealing with 2 sets of rules here. We're dealing with, and this is what I assumed before our caller, and I was correct when I talked to her. She was worried that she could not take another distribution because the bank wasn't letting her take another distribution because they're only letting her take required minimum distributions. That's a bank rule. She was worried that she was going to miss the federal distribution, because you have to take money out of your IRAs every year after you turn 72 or you're older. And so what we ran into here was the bank, the investment that she chose for this IRA was a 3-year CD.
So she's got, is it 100%? This IRA is 100% invested in this CD.
This 3-year CD. Yeah. There is a penalty, or substantial penalty for early withdrawal, whatever you want to call it, a penalty for taking money out before the end of the 3-year period of time. We're not going to reach the end of the 3-year period of time anywhere in 2022. But there is a waiver of penalty for an amount equal to the required minimum distribution.
Okay.
So they sent her a distribution penalty-free earlier this year. They're telling her, we're not going to send you another penalty free. We'll send you a distribution if you really want it, but there'll be some form of penalty. I didn't ask what the penalty will be. Usually it's maybe 6 months interest or something.
It's not good, especially in a low interest rate environment.
But the reality is, if it doesn't dip into principal, and I don't know if this one does or doesn't, a lot of bank CDs don't hit the principal. They just take away your interest. Mm-hmm. How much did the penalty can't be that much because it's not earning much interest. But anyway, she didn't want to take a penalty.
Sure.
And so she's stuck in between a rock and a hard place. So either she has to take a second distribution that's penalized by the bank, or she misses her RMD, which is penalized by the IRS. And I'm going to tell you that the IRS penalty is substantially more than the bank penalty is going to be.
Bank penalty?
Might be bad. 1 or 2%. Yeah, that's bad.
Federal penalty?
That's worse.
Exactly.
Because the penalty for missing a required minimum distribution is 50% of the shortfall. Now, in discussing things with her, I asked her, does she have any other accounts anywhere?
You mean like IRAs that have a required
Specifically,
minimum?
Do you have any other IRAs? She said, well, yes, I have others, but I've already satisfied the required minimum distribution from those. And are those in CDs that have penalties for taking more than that? No, some of them are in investment accounts, this, that, or the other thing. I said, well, you can always take more from, IRA B. If you can't take any more from IRA A without a penalty, but you can have access to IRA B, take the RMD from from IRA B and take an additional amount so that you satisfy the total amount. The IRS does not care which IRA in your name that the required minimum distributions come from. You can have 3, 4, 5, 10 IRAs. Now, technically, you're supposed to calculate the RMD separately from each one. But this language is holdover language from 20 plus years ago when they changed some rules. So the reality is you could add up the value at the end of last year for every one of your IRAs, divide it by the appropriate life expectancy factor. Now, we have some new ones this year, which help us out a little bit, but divide it by the appropriate life expectancy factor, and you come up with a number. That is the amount of money that needs to come out of your IRAs for this calendar year. It doesn't matter which IRA or even how many of your IRAs you tap into to take out the cumulative number. So if I have 3 IRAs and I have a $2,000 required minimum distribution from one, a $3,000 required minimum distribution from the other, and a $5,000 required minimum distribution from the third.
That's $10,000.
That means in total, I need to be taking at least $10,000 out of my IRAs this year. I don't have to take 2 from the first one, 3 from the second one, and 5 from the third one. I can take that $10,000 out in any form that I want from any of the 3 of them. I could take it all from one. I could take it a third from all 3. I could take $5 from one, $10 from the other, and the other $9,985 from the third. It doesn't matter as long as the entire RMD is withdrawn. It doesn't matter which account it comes from. Now, we are talking about your traditional IRAs. If you have decedent IRAs that you inherited from somebody else, that's a separate pool. You cannot combine that one with your own IRA.
Can you combine if you have 3 decedent IRAs, can you combine those?
Were they from 3 separate people or were they from the same person?
Let's say the same person.
Same person we can put together.
Different people.
But if I inherited one from my aunt and then another one from my uncle, those can't be combined together. They are separate pools for required minimum distributions.
Okay.
And if I have a 401k, a 457, a 403b, a retirement plan from work, and whatever it is that I just never rolled over to an IRA, that is a separate RMD pool as well. I have to take separate and distinct required minimum distributions from each of those different plans.
But we're talking about IRAs in this case.
And now if I have, and so if I have a 403b, I was a teacher, and I have 3 different 403bs, but they're all from the same school district. Mm-hmm. Now I can combine those because they're all the same employer, but each employer is a different pool, and my IRAs are a different pool.
401ks.
They're all different pools.
Same thing.
Yeah, so
maybe that's where she got hung up. Did she ask
part of it was her tax preparer said you really should be taking a separate and distinct distribution from each IRA. I don't know where they came up with that one. And
maybe they didn't know.
Well, maybe they just thought it's easier to keep track to make sure you've actually taken the right amount. But from an accountant, somebody who deals with keeping track of numbers, it's not hard to keep track of the number. So, if I need to take out $10,000, how much have I taken this year? Oh, I need to take some more. Does it matter what account I take it out of, other than the fact that it's an IRA? Nope, it doesn't matter.
So in her case, she was able to take out. She doesn't have to do her CD and get penalized. She can leave that alone.
She can take it from a different IRA account in her name.
She must have been happy to have talked to you.
She was actually very happy, yes. She's like,
did she know you from the podcast, or did
I'm not exactly sure where she knew us from, because it did not sound like she'd listened to the podcast.
Oh, okay. Well, anyway, she was happy to do that. Okay, now one last question on this, if I may. She took her 2021 RMD in January of 2022.
Right. She's trying to make up for it.
It's not her first one, so there's no grace period, as they say.
Right.
What are the ramifications, do you suspect, for having been a month or so late?
Well, my guess is that if she's ever caught for it, the fact that she wrote a letter to the IRS and said, I corrected it as soon as possible, I've taken the distribution, I've paid the tax. Every time I've seen this happen where the IRS has actually questioned it, the IRS just says, fine, don't let it happen again. That's not to say that they won't come back and hit you with a penalty, but I haven't seen it happen yet.
I think we talked about this at one time, where you can, if you missed your RMD, there are some certain things you can do. I know there are certain hardship situations.
What we hear the best thing to do is to take the RMD as quickly as
you can. Do it first,
yes. And document it. And then obviously take the next, like in her case, she had missed the 2021. Mm-hmm. She took it as soon as possible, but then she's also trying to satisfy the 2022.
Well, that's where the problem came.
And she's not trying to double count and say, well, this was both years.
Well, does she have to go back and amend? Well, I've
heard accountants do it both ways. I don't know which way is appropriate. Okay. I think just showing the taxes this year, because otherwise you run into the problem that you've got a 1099 for 2022, and let's say your RMD was $5,000 for 21 and $5,000 for 22, and you took both of them in 2022. So you've got a 1099 for 2022 that says $10,000, but you're only showing $5,000 of it as taxable.
Yeah.
And you're showing $5,000 as taxable in 2021, but there is no 1099. So that is probably going to trigger the IRS looking at you closer, rather than just showing it in 2022 and writing them a note saying, "Hey, look, this is what happened. I did it as soon as possible. I corrected it as soon as possible. I'm paying the taxes as soon as possible."
How do they know if if I have an IRA or a bunch of IRAs and I don't take an RMD?
Well, this is one of those confusing things that comes out around tax time. A form is sent to the IRS by your IRA custodian. It's called a fair market value form, otherwise known as a 5498. And it comes out usually just after tax filing date, but sometimes they send them out a little bit early. And so people then say, well, I got this form. They either got it after they filed their taxes. What do I do with this form? Because it looks like a tax form. I got to redo my taxes now? No, that's just an informational only form. The IRA custodian is required to tell the IRS what the value of your IRA was at the end of last year and what money's left, basically. Yeah.
Do they do this whether you're RMD age or not?
Pretty much, yes.
So every year they just say, here's what their IRA is.
You ever wonder
worth.
how you get to hear these studies that says there's $43 gazillion in IRAs out there right now?
Oh, because they get that info from the IRS?
They get it from the IRS.
Oh, wow.
So the IRS knows that, that's very easy to track. Their computers know how much was in it. They know how
your
old you are.
age.
Yes. Big Brother knows.
Well, a lot of people put it on their tax form, their date of birth.
Really?
Yeah,
Where?
and they put their Social Security number on there, too.
Well, you're supposed to put your Social Security number on there. Kind of how you pay your taxes. But that's how the IRS knows, and they can very easily determine, okay, so we know you had $100,000 in your IRA at the end of last year, and we know that you were X number of years, so you were 74 years of age, so this year the factor is 25.5.
So there should have been something coming out.
We better see we better see something in that line that says, how much of an IRA what kind of a 1099 did you receive from your IRAs?
Well, so the bottom line on this is that where IRAs are concerned, and not 401ks, not 403bs from different employers and all that, but where IRAs are concerned,
we can mix and match.
Traditional. Now, Roth is another story. Roths don't have a required minimum.
Not for the owner.
For the owner, correct. But you don't have to account for a Roth anywhere. Is that correct?
Assuming that you've had it for at least 5 years, and obviously if you're 72, you're past 59 and a half, those are what's known as a qualified distribution. Now, and so you probably didn't even get a 1099. If you did get it, it says that it's a qualified distribution, so it's not taxable. The only time you have to account for a Roth distribution is, let's say that I've had Roths for a long time. I've been, I started my first Roth in 1998, and I was contributing to them every year. I've had them forever, for as long as Roth's been around, more than 5 years. And let's say I'm 75 years of age, and so I am working part-time, and I decide to make a contribution to my Roth this year. I'm allowed. I'm working. I have the earned income to support it, and I put my $7,000 into a Roth IRA this year. But I don't put it into an existing Roth IRA. It's a brand new Roth with a brand new financial institution. Maybe I just put it in at the bank because I didn't know what else to do with it. And I go along, and then next year I decide, wow, I kind of need some money.
So you want to take
I want to take some money out of I take it from my Roth.
And you want to take the earnings out.
Well, let's say that the Roth has miraculously grown, $500. So I contact the bank and say, or the financial institution, and say, I know I only made the contribution last year, but it's now worth $7,500. Send me my $7,500. So they send me my $7,500,
which is $7,000 plus 500 of earnings.
I put my 7,000 contribution in. That's because I'm 50 or older. In this example, I'm 70 plus, but and I take the money out.
Yeah.
That IRA custodian, that Roth IRA custodian, doesn't know much about me. All they know is that I made my first contribution to their world of Roth IRAs last year.
And it's only a year old.
It's not 5 years old. And so, and then I took money out. So I've taken money out of their account. The fact that I have satisfied the 5-year rule somewhere else, they don't know that. So they will issue a 1099. And they will issue it as, I'm old enough, but I have not satisfied the 5-year rule. So I have to account for it on my tax return. It's very easy. I just put it in as, yes, I received a 1099 for $7,500. How much of that was taxable? $0. And you don't
have to say I've had a Roth. You just put it as taxable at $0.
I think you might have to do, there might be, there might be a form I have to fill out for more than that, but you're a tax preparer, tax, right. But it's not going to be taxable. But if I don't put anything on my tax return, if I don't account for it,
there will be a discrepancy.
That's very easy for the IRS computers to pick up. And in 2 or 3 years, we'll get a little nasty gram letter that says, you took a distribution, $7,500. As far as we know, it's taxable. So
500 is taxable,
or whatever they're going to go after.
Penalized.
So send us,
taxable and tax and penalized.
Well, it wouldn't be penalized because I'm in my 70s in this example. I'm not there yet, but I'm closing in. But in this example, yes. I'm in my 70s, and so even if I put money into a Roth IRA for the very first time at age 62, and I take it out at age 64, yes, I would pay taxes on the earnings, but there's no penalty on that because I'm past the age of 59 and a half. Once I get past 59 and a half, regardless of when the contribution's made, there's no more penalties. Whether it's taxable or not, that's based on the 5-year rule.
Yeah. So if you're 59 and a half and you take any money out of a Roth and you've had it for at least 5 years, there's no tax on earnings or principal.
So you might have to fill a form to remind the IRS. No, I've had Roths forever, so don't worry about this one. But the custodian may not know.
They're snitches, is what they're doing. They're going, he took money out of his Roth and had it for 5 years.
Well, that's the big deal about self-directed IRAs.
Yeah.
The reality is you still have an IRA custodian.
Yes, you do.
And it has to be a U.S., basically a U.S. trust company, U.S. fiduciary company, because they are required to be snitches.
That's what they do.
That is their job. They are required to tell the IRS that you took money out and when you took the money out so that you can be taxed or accounted for on your tax return. It has to be somebody involved. Retirement plans aren't the same way. You can be your own company and have a retirement plan, be your own administrator, and you're now your own snitch. But you have to file forms. But with an IRA, there has to be an IRA custodian.
Now, when you're in your example, when they sent a 1099 to the IRS saying money went out, you also got a copy of that 1099.
Oh yeah, I'm sorry, yes.
So
anytime your IRA custodian sends any of your information to the IRS, they send you a copy of the same form.
So you should
saying, yes, we told the IRS this, but we're telling you that we told them.
Yeah, so you can say,
it. But that's why we get that form and we're like, wait a minute, what am I supposed to do with this form?
Your example where you said I was 70 four, and I was still working and I had the income to support it, and I made a contribution to my Roth IRA. I had another question here. This leads perfectly into this because Janine or Janie, I don't know who, asked, can contributions be made into an IRA after I'm already retired? Now,
well, let's remember what the requirements for contributing to an IRA are. The first requirement is that you must have earned income. So if you are retired and not working at all, and you have no earned income during this calendar year or tax year, no, you cannot contribute to any kind of retirement plan. It requires earned income in that particular year.
What counts as earned income, Professor?
Wages, self-employment income, things like that. You going out and earning, having a job.
W-2 type.
W-2, Schedule C, self-employment. Pass-through income from rental property doesn't count. Basically, are you paying self-employment? This is not exact answer, but it's a pretty close one. Are you paying self-employment tax, FICA or self-employment tax on something?
Okay.
If so, that money is considered earnings, and you can use that to support an IRA contribution.
There was a rule.
Now, prior to the Secure Act,
yes,
when Roth IRAs came out, one of the nice things about Roth IRAs is there was no age limit. In our last example, we were talking about contributing to a Roth IRA at age 74. Since Roth IRAs came out in 1998, we've always had the ability, if we had the income at any age, to contribute to a Roth IRA. Traditional IRAs, however, had an issue that once you hit the required minimum distribution year, you no longer could contribute to a traditional IRA.
Whether you were working or not.
Had nothing. There was an age limit. The Secure Act did away with that. So now, regardless of how old you are, assuming you have earned income, you have the ability to contribute to a traditional IRA. Now, the ability to deduct a traditional IRA contribution has the same rules as anybody else, regardless of age. Your adjusted gross income, if you're covered by a retirement plan. And so, but usually by the time you're 74, 75, if you are working, you're probably working part-time. You're probably not covered by a retirement plan.
You say covered by a retirement plan.
If you're not a participant in a 401k, if you're not working for a company that contributes to a retirement plan on your behalf, whether it be a SEP, a defined benefit plan, a 401k, whatever, if you are contributing to a retirement plan at work, or your company is contributing to a retirement plan through your employment for that tax year, then there are limits on who can deduct a traditional IRA contribution.
So
you can still contribute. You just may not be able to deduct the contribution.
You're saying limits as far as income.
If your adjusted gross income is over certain thresholds. And
do you remember what they are for this year? I don't have my tax sheet here. So,
well, for a married couple, if you've got the person who is working, the threshold starts at like $125,000, give or take. So if you're over that, you cannot deduct. If you're trying to contribute for a non-working spouse or a non-covered spouse, non-covered by employment, the phase out's at 205 or 204, somewhere up there. So
it's fairly high.
It depends on what you're making. And now that isn't $204,000 of earned income. That's $204,000 of adjusted gross income. What's your adjusted gross income? That's all the income that shows up in the taxable column before deductions, basically.
What line is that on the 1040? I forget.
I used to know until they changed the 1040. Now it's like line 17 or so, but I'm sure that's off by a couple.
Well, whatever it is. You'll see it. It says adjusted gross income.
And it's not the very bottom line of the first page of the 1040 like it used to be.
Doggone it. Is that the simplified version?
Well, the simplified form now has all of it on the first page. Yeah. So you go adjusted gross income, deductions, taxable income,
and there it is.
But so you got all of them on the front page, where before it was the front page was all about the income, the second page was all about deductions and tax calculation.
So nowadays, if you're any age, you can make a contribution to.
As long as you're working.
Yes, as I say, yes. As long as you're working, you can make a contribution to an IRA. Whether you can deduct it or not depends on these income limits.
Now, for some people, it's kind of a wash, because if I'm 72, 73, 74, or older and I'm still working, I have a required minimum distribution. So I do have to take money out, but but it doesn't mean that I can't contribute some money back. So my RMD may be $5,000 because I have a $120,000 IRA, and I put 7,000 in. I mean, I could take the 5 out, put in my checking account, and then put 7 back in. 5 of it came from the RMD, but
is that okay?
Sure, it doesn't matter. I mean, did I take my $5,000 out of my IRA?
Well, once it's out of the IRA,
it's out. Now I can do anything I want with it.
Including,
am I eligible to contribute to an IRA this year? Yep. Then I can do it.
That's interesting. So but you can't just say, well,
I can't take it and say 2,000 for the difference.
Wouldn't that be nice?
We're going to net this out.
That's pretty good. One last thing on these IRA contributions. There was a rule as well that people have heard of about owning more than, say, 5% of a company. Does that have to do with IRAs?
No, that has to do with 401ks.
Yeah.
And that had to do with the deferral of the required minimum distribution. If I am working for a company through the year, it's still employed by that company at the end of the year, and I have a company-sponsored retirement plan, not a SEP, because that's a company contribution to an IRA, but a 401k, a 403b, a 457, any other kind of retirement money purchase pension plan, a profit sharing plan.
Any of those.
If I'm still working, I do not have to take a required minimum distribution from that employer's retirement plan, unless I'm a 5% or higher owner of that company.
In which case you do have to do it.
In which case you can't defer taking it. And also, we've run into the situation where XYZ, or a person owns a company, and as they're getting older, they transfer the company to their kids. Now their kids own the company, but they stay employed. They are no longer the owner of the company, but their kids own 100% of the company. They are considered part 5% owner.
The ones
the one who no longer owns it, but they're related to directly related to the owners of the company that are paying.
You've seen it all. It seems like you've seen it all. I don't know. Yeah. One last question.
I'm sure I haven't seen it all.
Well, you haven't.
Because every once in a while something pops up and is like, wow, that's a little nugget.
Haven't seen one yet.
That's a little nugget,
but it's good to know. One last question. It doesn't have to do with IRAs, but this is I think pertinent to. I don't even have a name on this one, but this is pertinent I think to this year where some people's portfolios have taken a little bit of a hit. Question is, when should an investor use tax loss harvesting? And for those who don't know what that is, we could do it very quickly, I suppose.
Well, that's where you have an asset that you purchased at a higher value than it sits today.
Yeah.
And you have a loss on paper. Mm-hmm. So I paid $10,000 for a mutual fund or a stock, and it's now worth $8,000.
Well, there's some people who may have done that very first of the year when the market was high.
Yeah, or towards the end of last year.
Whatever, yeah.
So I have a loss on paper. It doesn't do me any good on paper. Now we're talking about non-tax deferred accounts, by the way. This is your personal money.
Well, sure. You're not gonna. You can't. There are no realized losses yet.
And a lot of times we look at tax loss harvesting more in the years when we have gains. I've got a bunch of gains. I sold some stocks at a gain. I sold some real estate at a gain. And I'm going to get killed by taxes. At least in my mind, I'm going to get killed by taxes. How do I reduce that tax burden? Well, if I have some assets that are sitting at a loss, I could sell those assets, what they call realize the loss, change it from a paper loss to a real loss, and use that loss to offset the gain on other assets. So most of the time when we're looking at tax harvesting, we're trying to, get some losses to offset gains. Now, some people will look at it and say, well, I don't have any gains at the moment. But I have these losses. Is there a way I can do something with these losses? And to an extent, you can. I can use up to $3,000, a whopping $3,000. And it's been this same number, whether I'm married or single.
For 50 years?
For a long time, since
Forever.
Before I got into this industry. I think it started back in 82 or so.
I was thinking it was like back in the 70s.
Might have been.
Whatever.
I know I researched it once, but I forgot what the answer was. Anyway, I can create a loss. I can realize a loss and use that up to $3,000 this year over and above any gains that I might have to offset my salary, interest earned, IRA, other income, any kind of other income.
So if I bought an asset, say, for $10,000 and then it's worth $7,000 today, let's just say, and I want to use that loss, but let's say I've only owned it for 3 or 4 months.
Who cares?
That doesn't matter.
Not right off. No, I mean it only matters if you have gains, because then you have to use short-term losses against short-term gains first.
Let's pretend that is the harvesting that we're talking about, offsetting gains with losses.
That's part of it, but a lot of it is, can I use it to offset my other income? Because do I? And when I'm tax harvesting, when I'm looking at offsetting gains, I'd like to offset my short-term gains if I have them. If I'm going to create what are known as realized, no longer paper, but I've sold it and I've realized a gain. If it's a short-term gain, I'd really like to offset that short-term gain, because that short-term gain is taxed as basically as ordinary income. Long-term gains give me a preferential treatment. It's a lower tax bracket. So I'm going to try to find short-term losses to offset those short-term gains, because if I sell a long-term asset, something I've held for more than a year, it's first going to be used to offset the long-term gains. And I have to use it to wipe out the better taxable things before I can use it to wipe out the worst taxable things. So what am I trying to offset? Am I trying to offset short-term gains? Am I trying to offset long-term gains? Am I trying to offset ordinary income, at least up to the $3,000 mark? What assets do I want to sell? Should I sell short-term assets that I've held for less than a year that have a loss in them, or long-term assets? And then I can do other things.
Well, let's say I want to...
And remember, if I sell something at a loss, I can't just turn around and buy it right back.
Well, so here we go. So I have a $10,000 an asset I bought for $10,000. It's now worth $7,000, and I say, well, I don't really have any gain. I don't want to offset anything, but
I don't want to bankroll this loss for the future.
I'd love to offset this $3,000. I'd love to bring my taxable income down by $3,000.
Yes.
So I'm going to sell this asset now for $7,000.
Realize a $3,000 loss.
I've now realized a $3,000 loss, so I get my $7,000 instead of my $10,000 back.
But I like the stock.
But I'm thinking, yeah, this is probably temporary. I don't want to. I don't want to miss out. So what I'd like to do is sell this at a loss for $7,000, and then today or tomorrow, go back and rebuy it at what I figure is probably going to be virtually the same price, and wait, and
and then I'm still exposed to the stock. Well, it doesn't quite work that way. We've got something called the wash sale that says if you sell an asset at a loss, you can't re-own it within a 30-day prior or 30-day after. So I can't buy it today and sell it in 30 days, within 30 days, or sell it today and buy it back within 30 days. If I do that, I'm not allowed to take the loss. It's not that I lose the loss forever. What happens is, okay, in this case, I had that $10,000 stock. I sold it for $7,000. I have a $3,000 loss. And then I turn around and I buy that stock right back next week for $7,000. I'm not going to be able to take the loss. But how do they keep track of it? I have to adjust my basis on my new purchase. So it shows in there. So my loss is going to, so it's going to look like I paid $4,000 for that now holding of $7,000. So that if I sell that holding for $7,000 again, I have my loss there because my basis is $4,000 on that one. I adjust the basis on my new purchase.
Okay.
That's how they keep track of it. It's not that you lose it. It's not like, well, I bought it back and I lost a lot. I can't take it, but my basis in this newly purchased stock is $7,000, and so now any gain from this point will be taxable. I lost. You don't lose the loss. You just lose the ability to take that loss while you still own basically that same security.
So you will recognize the tax benefit when you sell that asset later on down the line?
Yeah, when you sell that newly acquired asset.
Yeah.
But it only happens if you buy it within 30 days before or 30 days after the sale at a loss. Now that doesn't have the same equivalency on sales of gains. If I sell something, if I have a bunch of losses, and we've seen this happen, and we may see it happen again if we have a downturn market like we might get someday, where back in 2000 we saw people with $1 million losses. 2008 we saw people with hundreds of thousands of dollars in losses. And they didn't have any gains for a while because they weren't in the market. They were afraid of the market. And so the only thing they could do is use it at $3,000 a year to offset ordinary income. Well, if you have $1 million in realized losses, and you can only use $3,000 a year, you got to live a really long time to recoup that benefit.
You've got to live at least a couple thousand years.
But maybe you had some real estate or you had some stock or something that you actually have a gain in. but I think it's going to go up even more. I could sell it, realize the gain, and then buy it right back.
Sell it, realize the gain, offset the gain
with the losses I already have, and buy it right back with a higher basis.
There is no wash sale on the way up.
There's no wash sale on a gain sale. There's only a wash sale when you sell something at a loss.
Well, that could be a pretty good strategy, because not only do you offset the gain, but you also have a higher basis
going forward. Yeah, it's a resetting of basis in some weird way.
That's kind of a nice thing.
And that way, we see this happen with older people a lot, that still think they're going to live a long time, but they never think they're going to, use up the loss that they had before. Yeah. So sometimes they look for ways to, at least in their mind, use up that loss.
Do you still see people on occasion? Or have you maybe
the big loss carry forward
with a loss from 2000 from the .com bust? I mean,
I haven't seen many lately. I think the last one I saw was maybe 2 years ago, but I saw somebody that was still carrying forward a rather significant.
I remember talking to people on the radio back in 2008 during that, and they said, "Boy, I still got losses from 2000, and now I got more here. What am I going to do with these?" So, interesting.
Make some money somewhere.
If you want to talk more about this, these are tax strategies. These are IRA rules and things like this. Stuff you need to know about. Professor Plum and the entire group at Lucia Capital Group, all the advisors, they work on this kind of thing every single day. 800-644-1150. The number at Lucia Capital Group, 800-644-1150. You can also go online, luciacap.com, LUCIACAP.com. That'll give you more information. You can read stuff, articles, you can watch videos, blog posts, a bunch of other stuff, or just to, talk to an advisor at luciacap.com. And again, 800-644-1150. If you'd like some more information on this, or you would like to have somebody look and review your portfolio. You guys do this all the time.
Yes, we do. We have fun with it, too.
You do. You do tax management. You do. You don't file taxes or anything like that. You don't do people's taxes.
I don't do the taxes, but I can help you understand them, and I can help you see where the tax bill may be coming from. Now, sometimes there's nothing you can do about it.
No.
But sometimes it's just nice peace of mind to know that, I've got $1 million salary, and I'm going to pay some tax on it.
Well,
and first,
get $1 million
salary.
Exactly. And Spotify is where you find our podcast. For those of you listening, you've already found that, but do go to Spotify. Tell your friends all about that. Subscribe. Get it downloaded directly and listen all you want. My thanks to Professor Rick Plum. We got more coming up. We're going to, in fact, next week, we're going to answer more of your questions. I'm going to do this 2 weeks in a row.
Wow. Cool.
We're going to be answering questions. I got to get caught up on some of these. We had a lot of annuity questions, and I want to talk about that next week. But we will do that then. In the meantime, my thanks to Professor Rick Plum, certified financial planner professional. For him, I'm your podcast host, John Eady, and thanks so much for listening. We'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claim claims paying ability of the issuer subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59 and a half, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.